Hello, this is Will Allen with Sentara Capital. Well, another summer has flown by, which in our house, we get excited this time of year because football season is coming up. But we're not here to discuss that today. We're going to dive into some of the recent developments in the financial markets. Let's go. To start things off today, we're actually going to do a flashback. Michael Brooks and I had a podcast that we posted on June 16th, so about 2 months ago. That happened to be the low in the stock market this year, came on June 16th. But let's look at something that we said late in the podcast. We are now back to very, very reasonable valuations. So I think there's a lot of positive. And if in the back half of the year we can get any progress on inflation, any progress on the bond market stabilizing, any progress in Russia, Ukraine, and any progress in China, hey, that'll be one more thing than we've had this year, because we've had nothing positive in any of those areas. Everything has gone against the markets. And I'm just saying at some point, some of those things are going to start to turn. And when they do, markets should react very strongly. The point we were making there was that in the first half of the year, the markets had 4 issues that were very challenging. The first 2 were the biggest 2. Interest rates going up, which we're also talking there about the Fed hiking interest rates. We had inflation. We also had the war in Russia, Ukraine, and we had the lockdowns in China. But the point there was that in the second half of the year, we were due for improvement in some of those areas. And specifically, we thought that inflation was likely to peak in the second half of the year. And we knew that the Fed, which had been hiking aggressively in the first half of the year, were going to get to ease up as we got to the back half of 2022. And sure enough, since that podcast, we have seen inflation peak. Gas prices, I sent out an update last Tuesday, where I pointed out that gas prices peaked actually in mid-June. They've come down now over $1 a gallon. Commodity prices have come down. Freight costs are down significantly. Used car prices. There's been improvements in lots of areas as it relates to inflation. And in fact, last Wednesday, we got a release of the Consumer Price Index. And if you take a look at this chart, you will see that month over month, prices actually flatlined last month, which is a big improvement because we had been seeing significant month over month increases in inflation almost all year long. Now, we still have a long way to go. Take a look at year over year consumer prices here. Still up 8.5%. So a long way to go to get to the Fed's target of 2%. But we have to start somewhere, and I think we did that last month. We also got producer prices. These are the prices businesses pay, and you can see that these actually declined month over month by 0.5%, which was a big improvement from previous months. Now again, look at year over year. We still have a long way to go, but prices peaked there at 12%. Year over year, we're at 9.75% now. So again, we still have a ways to go. There are areas like wages and rents that we have not seen improvement yet. So we will be watching closely in months to come to see if those start to turn lower. The first 6 months of the year was the worst start for the stock market since 1970. And one of the reasons stocks declined so much was that analysts expected in the back half of the year that earnings were going to fall off a cliff, that revenue growth would evaporate, profit growth would evaporate, and that's one of the reasons stock fell so much. Well, we are just wrapping up second quarter earnings season. And one of the things that we can say for sure is that earnings have been a lot stronger than anticipated. The deterioration that a lot of analysts have projected in earnings for the back half of the year did not play out. Take a look at this chart. Typically, when companies report earnings and they miss their bottom line, their profit expectations, they come up short, the company's stock prices go down. And in fact, you can take a look in the last 5 years. Every single quarter, companies that missed expectations saw their stock prices fall. In fact, in the first quarter, stock prices fell on average by 5% in the aftermath of their earnings release. Well, for the second quarter, we had something that we have not seen in 5 years, which is company stock prices were actually slightly higher. Now, how do I explain that? It boils down to this. There was so much negativity priced into shares. The market thought that this earnings season was going to be a debacle, and it just didn't play out that way. Right now, for the year 2022, FactSet, which tracks projections, has revenue growth for the S&P 500 for the full year at 12% and profits growing at just shy of 10%. Those are not numbers that you see when we are in a recession. You typically see a decline in revenue and in profits. Okay? So far, the outlook for the second half of the year, as we finished up earnings season, has been pretty darn strong. And we will closely listen to see if companies start to sing a different tune, but so far, so good. The Federal Reserve believes that the first phase of their rate hiking cycle has been completed, and that is taking interest rates from near zero to currently 2.33% for their overnight rate, which they consider their neutral rate. Below neutral means they are being accommodative, and when they go above neutral, that means they become more restrictive for economic growth. So their upcoming hikes are going to take the economy into a phase where policy is restrictive. They're doing this to try to bring inflation down to their 2% target. Likely talked about in the video, in the back half of the year, we were likely to get the Fed to begin to slow down their pace of hikes, which I believe they are at that place now. We also believed inflation was likely to improve. And we've seen commodity prices, gas prices have come down significantly. And that has helped to stabilize the bond market and led to a rally in stocks. So look at this chart. This is really key here for the next couple months. The Fed is going to try to thread the needle. They currently have rates at 2.33%, like you see there. I have an arrow in this chart showing that they're going to take rates probably closer to 4%. That's where the market thinks they're going to go. The question is, when they get there, will we see inflation coming down significantly and getting close to their target, or do they have to go farther? In the past, the Fed has tended to hike rates too far, sending the economy into a more significant recession. We have seen 1.3 million new jobs added in the last 3 months. That is a strong economy, and consumers are spending. So if the Fed can thread the needle and get to 4%, seeing inflation continue to come down, there's a very good chance that they can achieve this soft landing. And therefore, stocks 6 to 12 months from now can be higher than they are today. That's a feat a lot of people didn't think the Fed would be able to do 3 or 4 months ago, but now has become much more likely. But we will be watching and we'll keep you updated. Thanks.